Hello and welcome to another of our video series where we are meeting experts in various sectors related to the finance world just to get an understanding of the challenges that they're seeing in the marketplace. Today we're here at Poppleton and Appleby in Birmingham where we're joined by Matt and Andy. And Andy, I'm going to come to you first. Just a very quick sentence about who you are and what you do.
Yeah, first of all, thank you for having us today, Richard. It's much appreciated. Poppleton and Appleby is a business that's been around for in excess of 100 years. We are typically insolvency practitioners, but also business rescue advisors, and we typically get a lot of our work from the professional marketplace. So accountants and funders will refer us in. I've known Matt for, crikey, in excess of 30 years, and we've been partners at Poppleton and Appleby for approximately 20 years. As I say, just advising mainly the SME marketplace and trying to assist the advisors that bring the work to us to try and solve the challenges and see their clients through those difficulties.
So what challenges over the next 12 months? Obviously the insolvency sector has seen some interesting times over the last 2 years. You might want to reflect a bit on that, but where's it going?
It's proving really difficult to predict. The market is expecting some fallout from the post-pandemic experiences a lot of businesses have had. There's a lot of prediction about a wave of insolvencies and companies having problems, and I think you are looking at an absolute cocktail of problems going forwards. People that have got through the pandemic are now being burdened with a degree of debt. That debt now has to be repaid, and the circumstances are now getting even more difficult post-pandemic. Lots of stories in the press about supply chain issues, staffing issues, price increases, material costs, etc. And they've all got to be built into the business model somehow, and a business has still got to survive and pass those costs on to a client. So I think cost of everything is going to go up at a time when people are trying to deal with an awful lot of debt burden taken on during the pandemic.
And Andy, what's kept you busy over the last 12 months? Have there been particular industry sectors where you've been surprised to see some activity?
Not necessarily surprised because of the effects of the pandemic itself, but we've certainly seen businesses that pre-pandemic were very successful and decent businesses with good business models. But with the effect of the pandemic that literally turns the tap off overnight, then that does change the dynamic. So in the last 12 months, we've probably done a couple of gyms, we've done children's soft play centres, we've done a couple of coach companies. We had one that was in the European coach tour holiday sector, and obviously that had their marketplace just literally overturned overnight and just couldn't survive that kind of gap. It's different to our traditional work. That's usually the three misses that we've discussed. Mistake, misfortune, mismanagement, you always get those in life. So we're always going to get those and see those, but we are seeing a different mix now because of the businesses that probably otherwise wouldn't have been there.
Matt, you mentioned earlier these cocktail of challenges. Maybe you could just expand on that a bit for us, because running a business is a challenge in itself, yeah. But I'm guessing the last 18 months has just thrown up some things that people weren't expecting.
It's been the most extraordinary of times, and nobody's experienced anything like it. We've been approached, we've been asked to talk to quite a wide range of clients almost from the get-go of the pandemic. Very, very worried business owners because nobody knew what was going to happen next, how long it was going to last for. And I think everybody thought in the early stages of the pandemic, 3 or 4 months we'll be through this. And here, 18 months, 2 years later, we're still suffering the effects of it. The clients that we spoke to at the time, because of the uncertainty in the marketplace, because of the rollout of the government financial packages and the other support measures, a lot of them we were able to say, okay, just hang on for a bit, let's see what happens, let's see how this actually plays out. And as far as we can tell, a lot of the people that we've spoken to are still there. They've got businesses that are coming out the other side of this at the moment. I think the challenge is they're now sort of carrying the legacy or the burden of what's been happening during the pandemic. They may have taken on a lot of finance commitments because they were on offer at the time. And at a time when you want to bounce back and start getting the business out there again, then their next challenges could range for anything from material costs to labour in the marketplace to just price increases and just challenges. I mean, there is an absolute myriad of stories out there of the individual challenges that individual businesses are facing at the moment, and there isn't a magic wand answer for it. We've just got to find a way through it, basically.
I think, Andy, one of the things that I've seen is that the government has supported businesses over the last 18 months, which has been great, but there comes an end of that, and then are businesses looking sort of over the cliff, going, what happens next? I mean, what's your experience of that?
I think there's certainly an element of that. I think the first thing I should say is actually that the government measures have been really successful in terms of the furlough and the CBILS loans and the bounce back loans, but they've also done other measures in terms of restricted certain creditor actions, and landlords have been restricted in certain things, and winding up petitions have been devilishly difficult to get, and there's been a lot of forbearance in the economy generally, and I think that has stood its stead really, and been very, very useful. Obviously that is now starting to come to an end, and what we're seeing is businesses are, as Matt has indicated, that they now have that debt burden behind them. They've probably deferred the VAT because they were allowed to defer the VAT. They've now got to start paying all that back, and they're starting to run out of cash. So that's the sort of thing we're starting to see.
People always say in business this kind of cash is king mentality. If you've got cash, then it allows you to do things. How are you seeing that manifesting itself at the moment? In my own experience, for me, it's about manufacturing businesses having enough cash to be able to buy stock, to manufacture and to sell. Businesses pitching up on your doorstep. What's their experience on that?
One of the scenarios that we've looked at is a company that it manufactures certain larger components that might go into large commercial buildings. And the problems it's been having is brought all of its staff back from furlough, off we go again, the construction industry is opened back up again. The price of the raw material, the metals they were using, has gone up. The customer is then stretching out its drawdown times, and perhaps isn't taking its deliveries as often as it wants because it's got its own problems. And just general cost increases means that business model now looks different to how it did pre-pandemic. It was doing quite well pre-pandemic, and now it's struggling to manage its cash to the point where it's almost on a just-in-time sort of raw material type arrangement to get stuff in, and then it's having difficulties getting the customer to actually take its product so it can bill for the whole thing, and that's an extremely difficult one to manage.
I think some of that is also down to how they adapt. I think those businesses that can adapt and change their business model relatively quickly are those that have been more successful. And I think it's also worth saying that we get the majority of our work from financial advisors and accountants and the like, the professional community. And we're being told by an awful lot of them that actually we're seeing a bit of a two-tier economy. We're seeing a lot of businesses that are actually doing very, very well off the back of it. And we do see cash is king, you've said. We're seeing a lot of businesses that do have cash. Some of the businesses that we've seen decide to withdraw from the marketplace, we've still sold all those assets, and there's been an appetite for it, which has surprised us.
And are you seeing more businesses that are saying, do you know what, I've weathered so many different storms, I've been through the 2007 crash, but actually now is just the time to quit and get out? What's the view on that?
I think we've seen two sides to that. We've seen one element where, so as an example, I've done a fairly high-profile restaurant in Birmingham where it was very reliant on the footfall from the office fraternity. And you could see a scenario where, yes, it's opening up again and we're going to be able to open again, but what they couldn't see was, well, when do the offices return? Because actually I need both for this work to work as a business model, and they've just decided that actually they'll do something else because, the pandemic's 2 years, but it might be another 18 months before that recovers. We've also seen on the other side businesses that have been very successful for a number of years that are cash rich or got healthy reserves, and they've just decided that actually, again, I don't see this improving for another 18 months, and they've decided to cash in while they can. Matt often uses the phrase, I can't remember what it is.
It was stick or twist.
Sorry. Matt often uses the phrase stick or twist, and that's a decision that many have had to make. We've seen that on a number of the solvent ones we've done, where they've just decided that they'll cash in the reserves now and benefit from entrepreneurs' relief.
Well, one of the things we've seen in both the solvent and the insolvent, one of the many threads that you see is that eggs in one basket scenario. So some of the solvent ones, it's because they've got 60, 70, 80% of their turnover with one particular customer. It's that customer that's just said, okay, we're not certain what the future holds. No more orders, cancelling the order book for the foreseeable future, etc., which has just switched their tap off. And the same has happened on some of the insolvent ones. They've been wholly reliant on one key customer, and it's been a very comfortable relationship over many years. And once that dynamic changes, it throws them into all sorts of turmoil because they haven't got that reliability anymore. So, as Andy says, it's where you can try and diversify. And I think the one thing we've seen during the pandemic across all industries is people have responded really well to that need to either diversify or think things through differently. Particularly in hospitality, particularly in the sort of food and drink sector, it's become very imaginative, and it may leave us with some permanent good changes, but it does drive that need for diversity and a bit of lateral thinking, really.
In this environment, obviously, relationships with banks and other funders is absolutely key. Where do you see the banks and funders playing their part? I mean, if you look back at, say, the 2007 crash, banks got very involved with their clients and tried to support them as best they could. I get the feeling from what I see is that the high street banks are maybe a little less involved these days, and have got much more credit policy issues around them, and the alternative finance marketplace is maybe trying to help a bit more. But what's your experience?
At the moment, we're waiting to see, because pre-pandemic, one of the things we'd always explore with the client is if there's a difficult funding relationship or the scope for more funding to solve a problem so it doesn't become an insolvency issue, yet we'd encourage them to go and do that. We've actually had one or two clients during the pandemic where we looked at a retail one where its funding arrangements were just completely out of whack with its business. It was just paying far too much, far too quickly, and it was able to go and use one of the Sybil's loans to restructure its finance. And it's fine, they're grateful, it's gone through no problem at all. But we're kind of waiting to see at the moment, because an awful lot of banks obviously have supported and put in place either bounce back or Sybil's loans, and that kind of brings some structure already. There's the government imposed structure, so you've got your 6-year repayments, but you can stretch out to 10, you can take 6-month holidays. So it sort of leveled the playing field a little bit as far as those new loans are concerned. The bit that we don't know the answer to, we were wondering if you could help with this, is all pandemic loan arrangements put in place were great, they've served the purpose. But if a business has the need to either borrow more money, it's got an expansion opportunity, it wants to do various things going forwards, our understanding is that the government-supported loans aren't portable. You can't the only thing you can do is repay, as we understand.
It's a really good question, and I think one of the things I've seen in the sector is that certainly the bounce back loans and the CBILS loans have been great. But the government has kind of written the rule book on the hoof to a certain extent. So what started out as a really great thing and lots of businesses took advantage of, you're suddenly finding, as we're into that kind of, I'd actually like to refinance from lender A to lender B, is that the portability isn't there. Yeah. Now, whether that's the British Business Bank or the lender itself who's creating that rule, different people will tell you different things. But certainly it brings challenges. One of the things I wanted to have a chat about on a related subject is the there's reports in the news of a fair amount of fraud relating to the bounce back loans and the CBILS scheme. People applying for dormant companies and all that sort of stuff. Have you seen any of those issues land on your doorstep at this stage? We
generally don't tend to see those sorts of extremes, mostly because the cases we tend to do with, the clients we tend to deal with, are usually referred to us by accountants. So the clients tend to be a reflection of the accountants. So we don't really get to see the sort of the rogues and the vagabonds, if you like. But yeah, there is now a growing number of cases being reported in the press of the outright fraud. You know, something's been set up for fraudulent purposes, people buying Rolex watches and all sorts of things. It's it's, there are a few headlines in there. It's the should you have applied for that loan in the first place? Did it satisfy the criteria? Stage number 1. Stage number 2 is okay, you're okay for that bit, but what did you do with the money? The government clearly is now focused on following up as much of the fraud as it possibly can at the moment. It's going to take an awful lot of resource. I think the thing we're keen to see is make sure that the business owners that we get to see that have made good decisions in difficult circumstances aren't therefore penalised and being swept up in that push to examine every single fraud case that might be out there somewhere. It's not automatic.
I think we're hearing a lot of noise about the fraud and the misuse of the loans, and it's clearly out there. We aren't seeing many of those, is the honest answer. But what we are starting to see is those that are coming towards default, and you're having to look at, well, what did they use the money for? And we are seeing the odd example, where actually they have spent the money on a camper van. But many other issues, we are seeing them where they actually have used the money for paying the creditors and helping them get through the sticky patch, if you like. And I think it's just looking at those scenarios and where the risk is for the directors in terms of what they've done with the funds. We're starting to see that a little bit more. Another one of Matt's phrases, but we're sort of managing the back door because nobody was managing the front door. Right. So there was little due diligence done at the beginning, and as insolvency practitioners, we are being asked to look at what have they done with the money when things have gone wrong. There's another misconception as well in terms of some of the bounce back and CBIL loan type scenarios, because the general conception is it's all unsecured lending. But in certain scenarios, if you've gone to your existing bank who may have a charge in the background and they've got you a CBIL loan, then actually that security may still cover that loan, and that's going to impact on your marketplace in terms of, these businesses are now quite highly geared, and if they're running out of cash, it's another challenge in terms of how can you free up more cash for them.
And I think we're certainly seeing a scenario where people are taking on more debt to pay the existing debt, and you then look at how that works down the line, and they have to run even faster to stand still, and that then creates challenges that I see where people say, I'm a profitable business, and you go, that's great. But actually, by the time you take out all the finance payments, the amount of cash that's left is actually challenging. So I guess you're seeing a slightly different set of circumstances there where people say to you, I'm running out of cash, but I don't understand why, because we're profitable. And I guess it's understanding that scenario that's a challenge as well.
And there's also another problem in there as well, in so much that one of the changes that's come in terms of recent rule changes, and this is nothing to do with the pandemic, but HMRC have now got secondary preferential status back on some of their claims. So when you're looking at your security position and the bank security position, all of a sudden we've actually got somebody else
at the table.
Now at the table, further up in the queue. So that's also having an impact on.
We did see a client that quite rightly had taken a quite a sizable CBILS loan early stages of the pandemic. They were engaged in the VR and media support type industry, etc. Obviously, their tap completely switched off. So they took out quite a decent-sized CBILS loan at the time, and an element of which will be personally guaranteed. It was well and truly above the limit. And about a year or so later, they were still having problems, having to seriously think about an insolvency process that might have been a pre-pack administration or something like that. We spoke to them. I think the directors had settled in their own mind that even if they had to go through the process, they'd kind of worked out for themselves that their personal guarantee wouldn't be called on because there were sufficient assets in the business, etc. And we did have to break it to them, but in between you taking that CBILS loan and now having to think about an insolvency process, right in the middle of that, HMRC got their preferential or part of their preferential status back, combined with the fact that this company, just like many of the companies in the country, had parked up that VAT from the front end of the pandemic. There was a very, very sizable HMRC debt, and once you factor that in, which comes out ahead of the bank's security, suddenly their personal guarantee was exposed, and it genuinely came as quite a shock to them, and they had to really go and rethink their plans. But that's another one of those developments during the pandemic that I don't really think people have cottoned onto. There's been a shift in the value and the nature of security and how it works for the banks, whether it's pre-pandemic existing security or it's arisen as a result of the pandemic. but that preferential status can, if there's a large VAT debt and certain PAYE type debt, can impact on the bank's position. So again, one of the things that we're wondering about is bank and lenders thinking going forward must surely have to now take that into consideration for new loans. It really just put back on the table, is all your Crown debt up to date?
So we've talked about some of the challenges that you're seeing. Tell me how you bring something good out of these things.
What you're always looking for is an opportunity to save a business and have something going forward that can continue and survive. And the reality is that particular business right here, right now, has got a debt burden or a certain combination of problems that it simply cannot solve without a fairly drastic solution, which may involve an insolvency process. It's easy to think of insolvency practitioners as sort of the corporate undertakers and all the rest of it, but yeah, we do actually get to save jobs. We do actually get to preserve businesses and have something come out the other side of it. So we're always looking for an opportunity to have a business survive and carry on into the future.
Andy, any experiences on that particular front?
The most recent one, I've got one at the minute where it was involved in staff training and recruitment, but also part of the business was a conference centre as well. And obviously in the pandemic, the conferencing side has just disappeared completely, but the overhead that went with that was rather significant. And we've actually had a scenario where we've managed to hive out the training and HR side of the business and leave the conferencing bit separate. And that's been difficult because it leaves certain liabilities behind, but there has been a way of at least having part of that business survive with this sector, this side dying away. But we have managed to get that through and help there.
Most of your business comes to you from the professional advisor world. Are you seeing a change in the profile of businesses that are being referred to you at the moment?
Quite a few changes, and one of the ones we've noticed more recently, whether they've come from accountants or we are starting to get one or two that have found our details on the internet or in the phone book, are phoning up to discuss potential problems. What we're finding is the smaller owner-managed businesses, the sort of thing where you've got a limited company that's just there to deliver somebody's consultancy type services in whatever industry it is. Their corporate awareness perhaps isn't quite where it needs to be in terms of understanding. We've had a bounce back loan, we owe the government a bit of money, we want to close the company down, and then you probe a little bit further and you find that they've taken money out of the business, often not horrendous amounts, it's just been to live on, but it's done by just taking the cash out. It hasn't gone through a salary, it hasn't gone through a dividend or anything like that at all. And what we're having to explain to people is that kind of has to be badged as a director's loan account. If you've taken out more than the business owes to you, it is going to leave you in a position where you now owe that money back to the company. We did take a telephone call last week, a company that only had two creditors. It was a bounce back loan, £20,000 and Crown debt £5,000, and they were asking for quotes for a liquidation. But before we could give we probed only to find out there was a £50,000 overdrawn loan account which they hadn't got any concept of having to repay. So we more had to tell them that, look, find a way of repaying enough of your loan account to repay the bounce back loan and the Crown debt, because it's just going to cost you far much more money if it goes into liquidation, and with all the consequences that might come with it. So it's that corporate awareness of how they structure their business and how they extract their money from the business. That's one of the many changes that we've seen in who's sort of coming through our doors at the moment.
Andy, anything to add on that one?
Yeah, I think that's the main point, really. I think it's important now that directors do consider how they're remunerated, and accountants will often advise that they take the bare minimum in terms of salary and they make the rest with dividends because it's tax efficient to do so. Obviously, where you've had a CBILS loan or a bounce back loan, there's a question mark as to whether you should be taking dividends anyway, even if you have reserves. But certainly in scenarios where there aren't reserves and you carry on with that process, it does just create an overdrawn director's loan account and then gives you another problem in the event of a distressed insolvency scenario.
One of the things we're seeing at the moment in the finance marketplace is what I will refer to as the law of unintended consequences, which you may have used earlier, Matt, in a passing moment. We're seeing that as a someone takes a CBILS with their bank and then wants to raise finance elsewhere, and suddenly that CBILS becomes a bit of a drag. Are those circumstances that you're seeing where people are kind of being kind of kept in one place and not allowed to move on?
We haven't seen it yet, but we can see impacting on the sort of solutions that we would look at. So if we spot a situation where it might be solved by a revision or some changes to the existing finance, what we haven't met yet is what challenges does that bring. The CBILS loan, the bounce-back loans, did a very good job of stopping the financial boat from rocking and brought a degree of stability in some very, very difficult circumstances. But if a company's got either some expansion opportunities in the future or quite rightly wants to raise some more money to solve an ongoing trading or a cash flow or a financial problem, what we've yet experienced is how much of a burden might that CBILS be if the answer is I need to move to a different bank because my existing bank is either closed for business or won't entertain any further applications. Our understanding is the CBILS loans aren't transportable, and of course if you've got to borrow money to repay a CBILS, what that company's going to lose are the favourable terms and that pre-existing framework of flexibility going forward. There's a couple of sort of emergency buttons built into the CBILS loan that allow for payment holidays and extensions up to 10 years, etc. So that's quite valuable to a company at the moment. How do you preserve that, but also raise more money elsewhere going forwards when that loan arrangement is probably locked in under a debenture with a particular bank? We haven't come across that yet.
Yeah. Andy, are you getting many referrals from banks asking you to look at clients, or is it predominantly coming from the professional advisor world?
No, it's still predominantly coming from the professional advisors at this stage. I think the plug is still just about holding in the dam, so to speak, and I think we're expecting that probably more Q1, Q2 of next year.
So looking forward into next year, we always talk about the early warning signs. I guess one of the challenges I always see is that as an advisor, I'm brought into a process and quite often I'll look at it and go, I'm too late here. What's your advice to people who are thinking about getting some professional advice, be it on finance or distress issues? What's your advice to those businesses?
It's never too early to get advice. It's better to open the conversation and let somebody look at the problem from perhaps a different direction to the one you're looking at it from. It's one of those wood for the trees type moment. So one of the benefits that we've got, or any other advisor has got, is that ability to look in, but perhaps from a different angle, see a completely different picture, and if there are other solutions in there, try and identify those solutions and pursue them and see if they work. So it's never too early to seek advice.
It's always earlier the better, because what we are frequently seeing is that if somebody had come to us 6 months ago and asked us the question, we'd probably had a much better solution for them. But in that subsequent 6 months, then it just gets harder and harder and worse in terms of the position. It degrades even further, and then you perhaps can't quite do the rescue process you could have done if you'd done it earlier. You can still help them and still go through a procedure, but it is not necessarily as helpful as if they come to us early.
So on the subject of early advice, Matt, what's your views and how would you recommend people move forward?
One of the things that we see is that the longer people leave it to get advice, what you see is a huge deterioration of not just the financial position, but the relationship with its bankers, with its creditors. It's building up credit, it may build up HMRC debt. So the longer that goes on, the more damage is done, the more difficult it is to actually implement a solution. Get there that little bit early before that problem starts to grow, and you're more likely to get some cooperation, some forbearance, as we keep using the word, and some help from the creditors to actually solve the problem.
The phrase I always hear on these things is stakeholders. Or we need to get all the stakeholders to work with the business. Andy, is that something that you've seen?
Yeah, most definitely. And I think certainly in the current environment, certainly when there's a proliferation of HMRC debt, now is very much the time to talk to them. We did touch on earlier that at some point in time HMRC have to go back to collecting taxes, but certainly they recognise the process we've just gone through, and I think you'll get a relatively sympathetic hearing. But as Matt said, you need to talk to them early and engage with them throughout that process, and they will definitely work with you, providing you can demonstrate a relatively, sensible solution for them.
And in terms of time, I was speaking with a business last week who managed to arrange an 18-month repayment plan. Is that fairly typical at the moment, or is that an exception?
I don't think it's necessarily untypical. I think if you'd have asked me that question 2 years ago, I'd have said you've got no chance. Anything over 12 months and you're probably going to struggle. But we are hearing other stories of you can probably get maybe up to 2 years even. And I think it depends on the circumstances and all the requirements. But yeah, we're certainly seeing that sort of deal being struck at the moment.
I think in fairness to HMRC, they've got quite a difficult balancing act here. They don't want to see businesses driven under. They don't want to see sort of people go out of business, but they've also got to start collecting in the debt and refilling the government coffers at the moment. So they've we're going to come back to the word forbearance again, but I think there's a degree to which you'll get a sympathetic hearing at the moment, providing you've actually got a good thought through plan. If that plan has been supported by a professional advisor, an accountant, a finance or a funder, etc., then the more credible it's going to be, the more chances you're going to have of coming to an arrangement with HMRC that perhaps is outside of the pre-pandemic norms.
There's another consequence to that as well, in so much that just dealing with HMRC generally at the moment, the one thing that the pandemic has done is that it's diversified them all over the place, and with the working from home culture and everything else, it's just extremely difficult to get hold of anybody and talk to anybody with a sensible rationale. But that said, when you can get hold of people, it's almost created an environment where they are almost bending over backwards to try and come up with a solution with you, because it's easier for them to do that than crisis manage it themselves.
I think that's right. I was working with a client a couple of weeks ago who was talking to HMRC, and actually we spoke to someone on one of the helplines who understood the business, took the problem away and rang the business back 2 hours later and said, this is what we can do. And actually as a way forward, it was a solution you look at and go, that's actually really helpful.
You just want common sense to prevail.
Yeah. And I think when you can find that, it's great.
Yeah, and that's the challenge. It's getting hold of that person on the telephone to have that conversation.
Can you ever ring them back? No. They're never available, are they? So we talked earlier about some of the bounce back loan challenges, and I was reading a piece on the BBC website last week about how the government have set up this national intelligence service, or words to that effect, who are going to go out and sort of investigate some of these fraudulent bounce back loans. They were going to do 50 a year. Well, I'm pretty sure there's way more than that. I've seen situations where people have bought cars with bounce back loans and that sort of thing. What have you seen, and what challenges are there around actually getting to the real truth rather than what the press would like us to hear?
I think the concern we've got is what makes the headlines. Obviously, those extreme cases of absolute fraud, where people have fraudulently obtained bounce back loans, extracted the money, disappeared, and sometimes they're caught up within a liquidation scenario. Sometimes they're not. Hence the fact they've got a big push now on investigating other types of fraudulent use of the loans. The concern that we've got is there may well be clients out there that genuinely are in some financial difficulty, perhaps reached the end of the road or were struggling to survive, but they're being put off seeking advice because they can see these headlines and are wary of being tainted with the same sort of fraudulent accusations, when they've probably made some legitimate efforts to run their businesses properly, done the best they can in difficult circumstances, but the system isn't there to punish those people. What we're keen to get across to people is if you have had a bounce back loan, the one thing we will do is stop to try and understand before we even get too deep into an assignment, is what was the money actually used for? Can we see that it was used for business purposes? If it was used for salary, that seems to be okay, as long as it's at or below the rate we were taking pre-pandemic. And if there are any issues that need to be addressing, at least we can tell you what those are before you commit to a process. But seriously, don't be put off getting the advice you absolutely need because you're reading some headlines that look quite scary. You're probably not in those categories at all, but those headlines grab the more extreme examples.
I think what we're seeing is there's a level of what I would call a reasonableness test to it. we've touched on we're guarding the back door because nobody guarded the front door because of the lack of due diligence. But we are being asked to look at those scenarios, and we've seen a few where the DTI have took an interest in them and probably gone away because actually when you apply the reasonableness test, it's okay. I've had one scenario where a guy was setting up his own business and he borrowed some family money with the view that I'm getting some bank funding, but I want to start redoing my property so I can for the fit for purpose, but I needed the money earlier, so I borrowed a little bit of family money with the intention I'd pay it back from the funding. There's a question mark over that because when the money comes in, have you then preferred the family person as a creditor? But the reality of the scenario is that the business was perfectly okay and would have been fine, but it couldn't open on day one because actually on day one we went into shutdown. Yeah. And of course, business model is immediately turned on its head, and that was a common sense decision in the end. That okay, it looked a bit difficult, but in reality, I don't think the intentions was ever there that he was defrauding anybody, and a sensible outcome has been had. I've got another scenario where you've looked at what he's done with the money, and a director has taken out quite a lot of money in terms of debt that he was owed himself. When I actually did the full analysis of what's happened, he had a £50,000 bounce back loan, and on the day the money hit his bank account, he actually paid 49 of it straight back out to trade suppliers. In the next 4 or 5 months after that, he then was receiving different money from different contracts, this, that and the other, and he's paid everybody pretty much on a pro rata basis. So he did repay some of his own debt, but he did it on a pro rata basis. And then you look at that and say, well, actually, he hasn't really done anything wrong with the bounce back monies. And it's just looking at those reasonable analyses.
And I think it's one of those things is not necessarily, I think as you said, Matt, he's not listening to the scare stories in the media, but just applying common sense, looking at the detail and saying, is there a case to answer here? And if there is, fair enough. And if there isn't, then actually it's about making sure they've taken appropriate advice and covered all bases. So coming out of the pandemic, if we are coming out of the pandemic, one of the challenges that I think a lot of people are seeing is the how much can a business cope with kind of scenario. You've got bounce back loans, you might have got deferred VAT payments. People just, businesses have to run faster to stand still. How much more can a business take, and how is it you see those challenges manifesting themselves?
And I think that's the challenge that we can see for businesses over the next sort of 12 months and beyond, because you've got all the things that stem from the pandemic and the financial impact that may have had on a business. But other things are happening as well. We touched earlier on the new HMRC preferential status that might impact on your funding arrangements going forwards. But we have also had Brexit. It looks like we're facing interest rate rises, cost of living rises, raw materials increasing, problems in the labour market, etc. So it's not just the pandemic; it's everything that now stems from that. How much pressure can you put on a particular business before it starts to bend under the weight of those problems? So that's what we see the challenge being the next 12 months.
And one of the things I've seen is that sort of 2 years ago everyone was blaming Brexit. Now it's the pandemic, but Brexit's still there, isn't it? Brexit is still, if you think about the transfer of goods in and out of this country, these are still issues that remain, but actually have been superseded by other challenges. I mean, Andy, is that something that
I think that's absolutely spot on. I think it's Brexit, but you're not calling it Brexit because of the other effects that have sort of perhaps overweighed it. But yeah, certainly the supply chain, the driver shortage, cost of raw materials is all Brexit related, by and large.
And then you get these little things kicking off, like there's not enough tanker drivers and suddenly fuel is really difficult to get hold of for a couple of weeks. We do seem to be having a lot of these knee-jerk reactions to different sort of media stories that all of a sudden sends the country into a panic. I mean, I think this week we do have loo roll on the shelves, which is great, but a few weeks ago there wasn't enough turkeys for Christmas. Not that they vote for it anyway. So I think we're seeing a lot of those kind of knee-jerk reactions, where in previous times I think we'd have ridden that storm out a little better.
I think what it's leading to is a proliferation of spikes. So we've got the driver shortage. we might come through that. You know, the Christmas type issues, and we'll come through that. The fruit pickers, but we'll come through that. So you'll have a whole series of spikes rather than permanent problems. But each spike has to be gotten over by a particular business if they're in that sector, and that's part of the challenge.
And that's where adaptability comes in, I think. I think those businesses that are good at adapting to the changes, they will survive and be fine. It's remarkable how many of them have adapted, but I think the new norm, you know, you've heard that phrase on numerous occasions, and what does that new norm look like? But I don't think businesses will be the same. You know, all of these changes means people are having to adapt, and I'm not convinced it will ever go quite back to the level it was before. It'll all be different. So it is, how do you adapt to the new norm?
And that's very much the kind of post-2007 crash where people say we're waiting for the banks to kind of come back and do business as usual, and there was no return to business as usual. We had to get used to a new business as usual, and I think that will be the same again, where there's that new, this is what normal business looks like. And we have to adapt. And I think, Andy, you used the word agile, and that's certainly something we're seeing a lot of. You know, if you're nimble and agile and can cope with these changes easily, then great. But it's those businesses that have always done it this way that are going to struggle when things change, that are outside of their control.
You know, the standout sector for that is retail, isn't it? And the high street. If they haven't moved with the times, then you know you struggle to see where that's going. You know, internet and everything else has just been accelerated massively due to COVID and all the problems, and the high street will suffer
on an ongoing basis.
Yeah.
And what spins off retail and then into other sectors, and the next focus area to look at is the landlords. They're carrying an awful lot of this debt burden at the moment. Because people haven't been able to pay their rent during the pandemic, but the landlords have had one arm tied behind their back because the aggressive debt collection, the aggressive action they can take has been curtailed. And you can already see steps being put in place by the government trying to strike that balance between, okay, we've got to release that floodgate at some stage, but they're trying to put a sort of mediation type arrangement in place so that it doesn't lead to an absolute tidal wave of problems brought about by the landlords. But you've got the landlord solvency issues to think about as well.
There was hints of that before COVID struck, wasn't there? I mean, you think about Debenhams and the House of Fraser and all the kind of CVAs that were being forced through there. You know, landlords were already in a fairly bad place at that point, and this has just made it worse. And the challenge is how much longer can they last? And yet you still see new shopping centres being opened, particularly on an out-of-town basis, which brings the death of the high street in town and all the businesses that kind of live off that. It is a changing world.
Yeah, I think there's a plethora of things that will come from that, and you know, a review of the rating system. Yeah. You know, it's not just the shop rents; it's the rates that is horrendous. When you look at the retail businesses that we've looked at, it's a very difficult model to work in the current environment, and it's got to adapt and it's got to change. One thing that we did touch upon, Richard, is that we are seeing an element of a two-tier economy, and whilst we're talking about the sort of some of the negatives, we are also seeing some of the positives with some businesses flying, and with that has brought some opportunities. So we can see some consolidation in the marketplace, and we talked to some of the accountants we talked to, and certainly their acquisition teams are fairly busy. How do you see that from your side, and is funding a stumbling block there?
I think that's a really great question, Andy, and I think there are opportunities there. We funded a buyout last year of a business that, within hours of the rules changing around the fact you had to have PPE and hand sanitizer stations going into all the major retailers, within an afternoon had designed those pump action hand sanitizer units. They turned over an extra £10 million last year. Haven't continued to do that because it's kind of a one-off purchase, but actually that's taken them into new marketplaces, and actually they were very keen to get some of the silent shareholders out very quickly on the basis they could see their increase in value. There was a funding opportunity there, and we got that financed by March of last year. I think the other thing that we're going to see is that there's a lot of management teams who are probably approaching retirement and had an expectation of a price level that maybe has diminished somewhat now because actually they just want to cash out. The idea of we think it's worth X is great, but actually if someone comes along and makes us a decent offer, there is definitely money out there to support those kind of acquisitions, particularly where there may be some rollover equity or some deferred. People see the opportunity to kind of go and really move out and pass the business on to the next generation who have got the stamina to move it forward.
So we touched earlier on some of the candidates or some of the clients that we're seeing at the moment where they want to preserve the value of got their business, but they want to close it down and extract that value and as we say, stick not twist. There must be a lot of people out there doing well at the moment, possibly because of the pandemic. Some of the people we deal with might be acquisition targets for them. Some of the businesses out there, they may suddenly be in a position where they want to acquire and move into different sectors. Those things usually need funding. The funding market has just gone through a change like we've never seen before in terms of profile and structure. But if somebody wanted new funding for that sort of venture going forwards, who's open for business at the moment?
That's a good question, Matt. And I think, again, that landscape has changed. I think there's a number of challenges there. What people probably don't realise is that the high street banks do not have a great appetite for lending money. There's a number of changes taking place, so they're not doing what's called new to bank business. There's another added twist in that there's a couple of banks wanting to exit the UK marketplace, and so their portfolio is trying to find a home elsewhere within the banking sector, and that's quite difficult when quite a few banks are not open for new business. So I think it's fair to say that the usual high street lenders are out of the frame on that one. There's been some deals done, but I think their appetite it's really got to be very, very good business. But there's a plethora of other funders out there who are very keen. There are a number of social enterprise funders who have got British Business Bank funding who are keen to lend. Obviously, the Recovery Loan Scheme runs until June 2022, so that was extended because it was originally going to run out in December 21. So again, there are opportunities there. A lot of people thought, well, everyone will have borrowed as much as they could until the end of C-bills and then there'll be a lull. But there's always new opportunities coming around. So I think there is money out there for good businesses. The key thing is about having their finances in order, being well prepared and being well presented, because the requirements of the funders are that due diligence is a higher threshold than it ever has been previously. And we tend to find with a number of businesses that getting the presentation right is key. The story is usually pretty good, but the presentation is key to everything. One of the things that we've looked at in the last 12 months is a business that had just got going before the pandemic. And again, we were able to get a C-bills loan into that business that enabled it to kind of really motor the second half of last year. But the key to that was getting the presentation right. But there are definitely opportunities.
And are you seeing the gearing issue, if you like? Is there any more sort of flexibility from lenders when considering a C-bills loan or a bounce back loan scenario?
There's a greater understanding that people need to see what has happened in the last 12 to 18 months. So all lenders will now say, has your business being impacted by COVID? Yes or no? And what debt are you carrying because of COVID? And that's generally either C-bills or bounce back loans, but also, what is your deferred VAT position? And they are particularly careful that they're not inheriting someone else's problem. So there is, come back to the point I made, the threshold of due diligence is that much higher because they don't want to be inheriting someone else's problem. And anything with a British Business Bank backing has got a particularly long and awkward application form to fill in that does require a fair amount of time just to show that the due diligence has been done correctly, because the acid test will come in years to come when banks may be claiming under guarantees given by the British Business Bank, and you will see a plethora of situations where the banks say you didn't do your due diligence properly and therefore it will be thrown back to the lenders to start with. There will be a whole world of pain to experience on that over the coming years.